Hey everybody, Preston Brent here with our trader user group Wkly Round-Up. This is for the trading week ending September 22nd, 2017. Man, I tell you, we just keep making all highs every week, and it's, we see some sector rotation moving, but the markets still want to move higher. I know I hear a lot of folks out there getting very nervous. A lot of bears starting to come out of hibernation, even though we're moving into the winter time in the northern hemisphere of the U.S. Typically, bears go into hibernation, but now they're starting to come back out again. We're in 9 years on this secular bull market. I think it's the second longest in history. And gosh, just in the past year alone, we've had 40 all-time new highs in the Dow. So we're just constantly making new highs. And I believe it's a combination of factors, but clearly low inflation, low interest rates. We've had a global growth story that everything seems to be lining up, but there are a few flies in the potential ointment here, and let alone the geopolitical risk of North Korea on the Korean peninsula. But we've got just unbridled optimism in the markets. Anytime you get a lot of optimism like this, the markets tend to want to pull back. I've been saying all year we're a buy the dip kind of mode, and I still feel that way right now. I think we have a little bit more that we can run up. And for me, a dip is less than a 5% pullback. And then a 5% to a 10% would be a pullback. A dip is less than 5 to 10, it'd be a pullback. Over 10 is a correction. Over 20 is a bear market. So looking at the market here, you can see I've got the E-mini S&P 500 futures on the screen here. And you can see clearly in this drawing here that the vector is pointing in this direction. Okay, any pullback would put us right towards the bottom part of this area here, right around the 2450 area. You can see here it has provided a lot of support and or resistance. It's slightly below this volume over price area, and then we got another one sitting right here, which is sitting around the 2420 area, and then the mythical 2400 sitting right here. So we've got a lot of potential support points here that we can fall back on. But all of the things are all systems go. We got the 200 EMA pointing up in this upward vector, the 50 EMA. We got a cross in the MACD coming down that shows some weakness, but there is zero bearish divergence. Excuse me. So whenever you have a zero bearish divergence in the MACDs, that means, but we got a cross to the downside. Expect a little bit of weakness, but I would not expect anything more than, let's say 2 to 5%. Okay, so be a slight dip would be kind of what I would call for here. Now that is provided we don't get any crazy machinations from North Korea. Anything like that happens, then all bets are off and we can go down a lot further. But assuming that is the case, we don't have anything from North Korea, just rhetoric. The markets are learning to discount all of that rhetoric. This weekend we have the German elections. I don't see anything happening in the German elections that could upset the euro and the currencies and the bond market over in Europe, which would wash ashore here to the U.S. So I look at these markets here and I just say any dip, it's going to probably be bought at this time. Okay, now the key mover of the markets right now is going to be, we've already got the FOMC out of the way. And if you guys remember this past week when the FOMC came out, they started their BS strategy. I call it the balance sheet reduction strategy, or BS for short. And that really didn't affect the bond markets that much, nor did it affect the equity markets. In fact, the equity sold off a little bit and it ended up pretty much flat on the day, flat on the week almost. And you can see we're near all-time highs in the S&P 500 E-mini futures. Okay, so the only thing we have on the active radar screen right now is upcoming earnings coming up for, I guess in 2 weeks, 3 weeks, we're going to kick earnings off again. And this is going to be interesting. It'll be Q3 earnings, and so far this year we've had strong earnings. If we look at the Russell, which is small cap and mid cap, the interesting thing here is, check this out, folks. We almost made new highs in the Russell futures. In fact, we did. This Friday, we made new all-time highs in the Russell futures. And you can see here with this higher high, there is absolutely zero, and I mean zero, bearish divergence here, right? In fact, it's like this. That means that any pullback, again, is probably going to be buy on the dip kind of thing. The 200 EMA didn't really hold us up, but we did go below the open price back here in the middle of August. And then since then, we've just been on a tear straight up. This is small and mid cap. That would suggest that risk is coming back into the market a little bit. Now, I know a lot of people are pulling their hair out going, I don't understand. I mean, the market should be pulling back. Hell, we haven't had a 3% pullback this entire year. I think we're already going on like 260 or 270 days without a 3% pullback. So we're setting records here. But as long as corporate earnings stay strong, the dollar stays weak, which means corporate profits go higher, inflation stays low, interest rates stay low, then, it's just going to be conducive for higher markets. Now, this too will end. But I think near term, any dip is still probably going to be bought until we get through these earnings here in Q3, and then we're going to see what the markets want to do. But, as long as we're making new highs, new all-time highs, then we're not set up to fail near term, short of any geopolitical risk, of course. Look at the all-world index. This is Vanguard's all-world index. We made 2017 highs. There is no bearish divergence on this, and we set highs just a few days ago on the 19th. All right, that's the all-world index. If we look at the Asher, it's the tracking ETF for China. China is near all-time highs. Now we're pulling back, but there is no bearish divergence on that one either. Let's take a look at transports. If we look at the Dow transports right here, we're near the 2017 highs. Okay, and then if we look at the Dow futures, right, and kind of just see what they're doing, we're only just a day or two off of all-time highs here. So the fact that I hear a lot of screaming, blood-curdling screams that the bottom's going to fall out of the markets, it's just not true. Can we have a dip? Yes. 2 to 5%. Now it's going to sound like bloody murder because a 2% move or a 3%, 4% move when the indexes are this high, can mean, 50 to 100 points in the S&P. Volatility is still very low, so we could get some spikes, but I think buyers are going to step in. I don't think the shift in this market is going to happen yet. I don't see anything that can turn this dip into a correction, meaning going lower than, greater than 10%, or really more than 5 or 6% to the downside at this point in time. And of course, if we look at volatility, here, then you're going to see right here that this the vol had we finished the day at 959. I mean, that's very low, really very low. I mean, we're near 2-decade lows here. So that is a little bit of a cautionary sign here, 8.84, right? I mean, that's a cautionary sign. That means that, we could be prepared for a spike, but we haven't had these spikes last very long. These spikes just don't, they stay up here and then they don't last very long. They just kind of come up and they come down. So again, we got to be very careful about this, but I just do not see a prolonged volatility event on the near-term horizon, not until we get through corporate earnings. Now, if corporate earnings start to go south on us, then we could start to see a little bit more of a pullback. But as of now, I don't see it. Now, if we take a look at some of the currency market, right? If we look at the British pound, the British pound is something that, you've probably heard me pounding on the table. I've been long and just bullish the British pound. Granted, it's been a wide, choppy move, but this is just a buy of the lifetime down here with the pound down under, the 122 area, 123. You can see the upsloping channel here. So this is kind of where it's going, but this is kind of how I see the British pound moving. The dollar has just been decimated, and it is going to take a lot to get this off the dime here. Even though there's a little bit of a divergence to the upside here, there are a lot of shorts in the US dollar. So it's going to take a lot more hawkish Fed to get the dollar moving to the upside. By the same token, Super Mario Draghi's got his work cut out for him with the euro. You can see the euro's near 2017 highs. And back over in this area here, if you guys remember, I was saying we got to get long the euro because the euro looks like, and I had called the low around 102 and we didn't quite make it. In fact, we went down to 1037. So I missed the low, but we were right on time here. And then as it started moving higher, like the British pound, I said this thing can move up into the 117 area, and it overshot. It went up into the 120. So it went actually more bullish than I thought. But now Draghi's got an issue. He wants the euro to be a little bit weaker than it is right now because it's going to start to hurt the European recovery efforts. So let's see if he can talk the euro down. But I'm not playing the euro or the dollar right now. I'm more interested in the British pound. Gold. Gold did exactly what I said it was going to do, guys. I said it was probably going to come back and find the 1300 area, and if you look at it, it finished the week at 1297.5. Gold hates a hawkish Fed. It hates a stronger dollar, but it hates higher interest rates even more. And you can see here how gold has come back. Now, I would expect there's going to be an entry point for us in gold. I think this is going to probably do one of these rounded bottoms, and then when it starts up again, and then it's going to hit a trigger point for us, and I'm going to have our members jump in on gold. Right now is not the point, even though it finished up a little bit today. The past couple of days has been very ugly for gold, but we're going to play that, and I think it's going to be a good opportunity for everybody concerned with gold to the upside, just not yet. It's sitting right on the 50 EMA right now, but you can see that upsloping channel. All we're doing right now is kind of establishing ourselves back into the channel again. You can see the 50s cross the 200. I do believe we're going to be running up higher in gold, just not yet for a trigger. Oil. Well, they were meeting in Vienna, OPEC, and nothing really came out of the news there. Russia did come out and say, well, we may look at extending the production cuts in January. Now is a little bit too early. But I've got our members. We're 17 trades in a row on our oil trade. You can see this downsloping trend line. We finally took it out. We got bullish oil back about 2 weeks ago. It's going to have a little bit of difficulty here. I think oil is going to hold the 45 to 55 area for a little bit longer, at least through the end of this year, short of any OPEC news that would unbalance things. But I don't see that happening before the end of the year. So we're going to continue on. We're going to press forward with our oil trade. It's working out very nicely for us, and we'll just continue that thing as it goes. All right, everybody, this was a really quick update. I'm going to be flying down to Florida this weekend, getting my office recalibrated down there after the hurricane. Otherwise, members, I will see you Sunday night for our weekly market watch. And then everybody be on the lookout for our option masters education series email. I'm going to be sending that out to you sometime early next week. That's something you definitely want to get on board with. All right, everybody, have a great weekend, and I'll see you guys later. Ciao, folks.